There's this specific, almost gnawing frustration you feel when you turn on the news lately.
Oh, I know exactly what you mean.
You see the headlines, you hear the polished pundits, and the phrase is always the same, just repeated like a mantra. Strong economy. They just keep telling us everything is fine.
It really is the don't believe your lying eyes phase of the economic cycle. I mean, it's gaslighting on a macroeconomic scale.
Exactly. Because when you actually stop listening and start looking at the data, specifically the numbers that just dropped for January 2026, that strong economy narrative, it doesn't just look optimistic. It looks like a complete fabrication.
It's a fabrication.
We are not looking at a soft landing. We are looking at a brick wall.
We really are. And I think the reason people feel that dissonance, that gap, is because the story being told and the spreadsheet being balanced are two totally different things. The narrative says growth, but the ledger shows we are walking into a massive structural realignment.
And that is exactly what we are unpacking today. We're calling this deep dive structural instability.
A good name for it.
Because we aren't just talking about a bad month of jobs reports. We are talking about a fundamental shift. We've got a layoff tsunami in the U.S., a complete changing of the guard in the auto industry, and a date circled on the calendar, February 8th, that could trigger a global liquidity crisis.
And the mission for this deep dive is really to connect those dots. Because on the surface, shrinking paychecks in Ohio, a falling U.S. dollar, and, central banks in Asia hoarding gold might look like three different stories.
But they aren't.
They aren't. They're all symptoms of the same transition. We're moving from a world built on paper assets, stocks, bonds, promises, to a world that is demanding hard assets. And, well, historically, that transition is violent.
Well, if we're talking about violent transitions, we have to start with the labor market, because the numbers we saw for January 2026 were shocking. I think bloodbath might be the technical term here.
It's certainly the appropriate feeling. The raw data shows U.S. employers announced 108,435 job cuts in January. Just January.
Okay, so help us contextualize that number. Is that just a seasonal, post-holiday thing, companies trimming the fat?
No, this is way beyond seasonality. That's a 118% increase compared to this time last year. It is the highest January total since 2009.
2009.
And you have to remember what was happening in January 2009.
We were right in the teeth of the great financial crisis. Lehman had just collapsed. The whole system was shaking.
Exactly. So we are seeing job destruction at a rate we haven't seen since the entire banking system almost collapsed. That suggests some deep, deep distress in the corporate sector.
But here's the thing that really scared me when I dug into this. Layoffs happen, companies pivot, but usually if you get laid off from company A,
You can find a job at company B.
right, but the hiring data, it's basically non-existent.
This is the critical takeaway right here. The layoff number gets the headline, but the hiring number tells the real story. In January, across the entire United States, companies announced plans to hire only 3,300 workers.
Hey, hold on, let me repeat that. 5,300 in the entire U.S. economy.
That's correct. An economy of 150 million workers. It is the lowest hiring number ever recorded since they began tracking this specific data point back in 2009.
So the engine has just...
It seized up.
It's a freeze, a complete freeze. If you lose your job right now, the statistical probability of finding a new one immediately has just plummeted because nobody is adding headcount. They're all shedding weight.
And it's not just small businesses folding, it's the titans. We saw UPS cutting over 30,000 jobs, Amazon slashing 16,000 corporate roles, Dow 4,500. The UPS one, though, that really stuck out to me.
The Amazon connection.
They cited winding down their relationship with Amazon.
That is a huge signal. I mean, when the giants start eating each other, you know the pie is shrinking. But there's another detail in there we need to talk about. Artificial intelligence.
The robot revolution. Is it finally showing up in the hard data?
It is. AI was explicitly cited as the reason for 7,600 of those job cuts. Now, that might sound small compared to 100,000, but it's the trend that matters. Before, automation was a theoretical risk. In 2026, it is a line item on a spreadsheet. So if I'm an executive, I'm thinking, why hire a human with benefits and sick days when I can just license an AI agent for a fraction of the cost?
Precisely. It's a ruthless calculation, but it's happening.
So, okay, zooming out. Jobs are evaporating, hiring is frozen, automation is ramping up, but when I go to the grocery store, prices aren't coming down.
No, they aren't. And that leads us to the dreaded economic term, stagflation.
Define that for us, because it's the worst of both worlds, right?
It is the nightmare scenario for central banks. Stagflation is when you have stagnant economic growth. which we clearly see in this labor collapse, combined with high inflation. So consumer costs are still rising.
And this puts the Federal Reserve in a bind. I've heard this called the Fed trap.
It's a trap with no good exit. Think about it. The textbook way to fight inflation is to raise interest rates, right? Cool things down.
Right.
But if they raise rates now, they crush the labor market even further. They risk bankrupting a debt-laden economy.
Turning a recession into a depression.
Exactly. But if they lower rates to try to save jobs, they pour gasoline on the inflation fire and accelerate the debasement of the currency.
And debasement of the currency is the perfect pivot. Let's talk about the second major crack in the foundation, the U.S. dollar.
The greenback.
For my entire life, the dollar has been the safe haven. When the world gets scary, you buy dollars.
Yeah.
But looking at the charts now, that seems to be breaking.
It is flipped. This is a crucial concept for you to grasp. We are seeing a regime change in how the world treats the dollar. The U.S. dollar index, the DXY, just hit a 6-year low of 96.0.
Wow.
It fell almost 10% last year, and it's already down another 1.8% in January.
But why? If the world is so unstable, why aren't people rushing to the dollar?
They would if they trusted the balance sheet of the United States, but right now we are seeing the hot potato effect. Major economies look at our fiscal situation, the $36 trillion in debt, the deficits, and they realize that by holding U.S. treasuries, they're just losing value. They're holding a melting ice cube.
So they're selling.
They are dumping. China's holdings of U.S. debt are down to their lowest level since 2008. India cut their treasuries by 26% in just 1 year. These are massive exits.
Okay, but if you sell the dollar, you have to put that money somewhere. Where do they go?
That is the trillion-dollar question. And the answer is fascinating. They aren't moving into euros or yen. They're moving it into gold.
The ultimate hard asset.
China has been on a buying spree for 14 straight months. India added almost 40 metric tons in the last year.
So let me get this straight. The U.S. dollar is shifting from a safe haven to a risk-on asset.
Exactly. It's behaving like a tech stock. When volatility hits, people are now selling the dollar to buy something tangible. It's a vote of no confidence. It's the world saying, we don't trust your promise to pay anymore.
That is unnerving. Now, speaking of volatility, you mentioned a specific date earlier, Sunday, February 8th. Why is this coming Sunday keeping economists up at night?
It all comes down to Japan. And I know you might be thinking, why do I care about Japanese banking policy? But you have to understand, Japan is the largest foreign holder of our debt, about $1.2 trillion worth.
So they're our biggest banker.
Correct. And for decades, Japan has been the land of free money. They've had zero or negative interest rates, which created something called the yen carry trade.
Okay, break that down. What's a carry trade in plain English?
Think of it like a free credit card with no limit. Investors would borrow yen from Japan for basically nothing. They'd take that cash, convert it to dollars, and buy U.S. stocks, crypto, real estate, anything that pays a yield. It was a massive pump of liquidity into our markets.
So American stock rallies were partly funded by cheap Japanese money.
It was a liquidity hose. But on February 8th, Japan makes a critical decision on its interest rate policy. Inflation is rising there, and they are under immense pressure to finally raise rates.
And if they raise rates?
The free credit card gets canceled, the spigot turns off, but it gets worse. If rates go up in Japan, Japanese investors might start selling those U.S. treasuries to bring their money back home to Tokyo.
And if they sell $1 trillion worth of our bonds?
It creates a massive supply shock. When you flood the market with treasuries, the price drops and the interest rate spikes.
And U.S. Treasury yields set the price for everything else. Mortgages, car loans.
Exactly. Mortgage rates go up, business loans go up, and typically when yields spike like that, the stock market crashes because money just became expensive.
So the fate of the S&P 500 might literally be decided in a conference room in Tokyo this weekend. That is wild.
It just highlights how fragile the whole system is. We're totally dependent on that foreign liquidity.
And speaking of the stock market, let's look at Wall Street right now. The magnificent 7 tech giants. They aren't looking so magnificent lately.
No, they're really dragging the index sideways. Even companies with solid earnings, like Amazon and Google, saw sell-offs. The market sentiment has really shifted. Good is not good enough anymore.
Because expectations were priced for absolute perfection.
Right. And now that liquidity is drying up, we're seeing a rotation. But there's a technical indicator in the notes that I found. Well, pretty worrying. The Hindenburg omen.
Please tell me that is not as bad as it sounds.
It's not great. It's an indicator that basically measures if the market is falling apart underneath the surface. And we've seen 3 of these signals trigger in just the past month.
And historically, what does that mean?
Historically, when you see a cluster like that, the probability of the market going up is only about 27%.
I do not like those odds.
Yeah.
So if the smart money is seeing this, where are they going? If they're leaving big tech, where do you hide?
They're rotating into defensive sectors. Consumer staples and energy,
Toothpaste and oil.
boring stuff. Things people have to buy even when they're broke. It's investors battening down the hatches. They're moving out of growth and into survival.
There was also a note here about dark pools. What's going on there?
So dark pools are just private exchanges where the big institutions trade without the public seeing their orders.
So they don't spook the market.
Exactly. And we saw massive dark pool activity, big hidden trades in silver and software ETFs right before some major price drops. It suggests the smart money is quietly positioning for a fall.
And what about crypto? Bitcoin dropped to around 67K. Is that related?
It's driven by liquidations. When liquidity dries up, the most speculative assets get hit first. Bitcoin dropping to that specific demand zone suggests people are needing cash. They're selling what they can sell to cover losses elsewhere.
Okay, I want to pivot to a specific industry because I think it perfectly illustrates this global fragmentation we're talking about. The auto industry. For years, the story was simple. Tesla is king.
That was the narrative for a decade.
But the 2025 numbers from Europe, they are a disaster for Tesla. What happened?
It is a complete reversal. Volkswagen is now the #1 EV brand in Europe. VW sold 274,000 EVs, that's up 56%. Meanwhile, Tesla sold 236,000, which is a 27% drop.
A 27% drop for a growth company is catastrophic. And in Germany, their registrations collapsed by 48%. That's losing half your business. Why?
It's three things. First, yes, the portfolio is aging. Tesla's still relying on the Model 3 and Y. VW has launched the ID.4, the ID.7. They're just flooding the market with fresh options.
Okay, product fatigue. What else?
Strategy. VW is aligning perfectly with EU sustainability rules. They're playing the political game. Tesla's approach is seen as too transactional, just exporting from China or the US.
And the third reason?
Politics. And this is fascinating. The data explicitly cites reputational backlash against Tesla's political positioning as a direct factor in France and Germany.
So the brand has become polarized.
Exactly. And in Europe, consumers are voting with their wallets for the local champion, Volkswagen.
So what does this mean for the global market?
It means the era of the single global dominant player is fading. We're seeing the rise of the regional champion. Volkswagen wins Europe. BYD is crushing it in Asia. Tesla holds the US.
The world is splitting apart.
It's fragmentation. The global supply chain is breaking down into regional fortresses.
And that leads us right into geopolitics. We have some news on the US and Iran, which is, surprisingly, a bit of good news.
A rare bit of de-escalation, yes. Indirect talks seem to have stabilized the oil market for the moment. They're trying to prevent a full-scale war.
So the shooting war might be on pause, but the economic war seems to be ramping up.
Oh, the economic war is going nuclear, specifically the mineral war.
This was fascinating. The U.S. is establishing price floors for silver, copper, and rare earths. Explain what that actually does.
So for years, China dominated these markets by using predatory pricing. If a U.S. company tried to open a mine, China would just flood the market, drop the price to nothing, and bankrupt the American company.
Bleed the competition dry.
Exactly. So now the U.S. government is stepping in and saying, we will guarantee a minimum price. If the market price drops below X, the government will buy it at X.
They are removing the risk for domestic miners.
They're essentially nationalizing the risk. They announced a $12 billion critical mineral stockpile. It's a massive shift away from free markets.
Because you can't build EVs, missiles, or microchips without this stuff.
It's national security. The U.S. realized that relying on China for the ingredients of the 21st century is a chokehold.
But doing this guarantees stockpiles.
Yeah.
This costs money the U.S. doesn't really have.
And that brings us right back to the debt doom loop. This is the big picture for everything we've discussed today.
Give us the summary on the doom loop.
The U.S. dollar share of global reserves has dropped to 57%. It used to be 71%. As demand for the dollar drops, the U.S. has to offer higher interest rates to attract buyers for its debt.
So we have to pay more interest to borrow money.
Right. Higher rates mean higher interest payments on the debt. That leads to bigger deficits, which leads to more printing, which leads to more inflation, and even less confidence in the dollar.
It's a spiral.
It is a self-reinforcing cycle. And while we're trapped in this loop, China is positioning the yuan as a currency backed by physical gold.
It's a battle of philosophies. A fiat system based on debt versus a system anchored in tangible assets.
Correct. And history tells us that in the long run, tangible assets usually win.
So let's bring this all together. If you had to summarize this whole deep dive into one core takeaway, what is it?
The three line is that the strong economy narrative is cracking under the weight of reality. We are witnessing a regime change from financial assets, things that can be printed, to real assets.
Yeah.
Commodities, gold, regional industry.
The debasement trade.
Exactly. The debasement trade suggests that in a world of spiraling debt, ownership of tangible value is the new safety net. You don't want the promise of value, you want the value itself.
It's a sobering thought. We spend so much time looking at the number in our bank account, assuming it's solid.
But if the currency itself is losing value, that number is an illusion. You might have the same number of dollars, but they buy less of the world every single year.
So here's the final thought I want to leave you with today. With the U.S. government establishing price floors for minerals and China backing its currency with mountains of gold, are we returning to a world where money has to be made of something rather than just printed by someone?
That is the question of the decade.
And if that's the case, what does that actually mean for the savings sitting in your bank account right now? Something to think about. Thanks for diving in with us. We'll be watching February 8th very closely.
Stay curious and watch the data, not the headlines.